Yes, I think, to describe the long-term debt cycle, we can start with the short-term business cycle, the normal credit cycle, which is basically you have an economic expansion, you get rising debt to GDP, and then either the Fed kills it or it runs its course or some external shock happens. Something eventually causes some sort of rollover period of economic contraction. You get deleveraging of some of the malinvestment or over, kind of over entities that got over their skis. And the issue is that because of how the system's constructed, policymakers come in and try to short circuit that process and make it smoother and shorter than it otherwise might be. And so they cut interest rates. They basically try to emphasize credit growth during that credit contraction. And as a result, when you string a bunch of these together, instead of having like a sine wave of debt to GDP, you get like an upward sine wave where you keep getting higher debt relative to GDP. So higher highs and higher lows, and interest rates are going the opposite direction. You keep getting lower lows and lower highs. Each cycle, you're squeezing more juice out of the orange for how much credit growth you can get. And eventually you run into the zero bound, or in some cases mildly negative, and then it becomes, pretty challenging because instead of higher debts being offset by lower interest rates, so lower servicing costs on the debt, now there's not really that lever anymore. And so that's, both times in history when you ran into the zero bound for the first time after like, either forever or decades. It was 1929 and it was like 2008, right? So these were major events in financial history because you got to the end of kind of, this long period of credit growth. And so what makes the ensuing process different is that there's so much debt in the system that they can't really deleverage nominally because like there's just so many claims for dollars compared to how many dollars there are that it's just like a game of musical chairs with like 20 kids but then like five chairs. It's a disaster when it happens because they built it up to such kind of artificial heights. And so generally what you get instead is you'll get some deleveraging, but then you'll also get currency devaluation, where if the numerator is super high, one thing they can do is tweak the denominator, basically create more money units, add more chairs to that game of musical chairs. So if 20 kids try to sit down on five chairs, you can be like, well, let's put, another 10 chairs there. So only five kids don't sit down, right? And so that's essentially what they do. They end up creating a lot of money. And then the problem is you get a lot of inflation. And, so if you go back to the 40s, for example, when they were fighting the war, they got over 100% debt to GDP, and you gave up independence for the central bank. They said, look, you can't just jack interest rates up to positive real levels. We need you to finance U.S. debt to win this war. And so you had large fiscal expenditures, large inflation that followed it, and then the central bank was holding rates near zero and even capping the long end of the treasury curve for years to finance all that government debt at negative real rates, deeply negative real rates, which is basically a type of kind of gradual default. And there's a study by Hirschman Capital, I believe it was, that showed that over the past 200 years, 98% of countries, if they get their sovereign debt to 130% of GDP, over the next 15 years, you're going to default one way or another. If those debts are denominated in a currency you can't print, like if you're an emerging market that owes dollars, or if you owed it in gold, if you go back long enough in history, you end up just kind of defaulting or restructuring in some way. And if it's denominated in your own currency, instead you generally get that financial oppression environment where, of course, they get paid back every dollar or euro or whatever that they're owed, but those are generally worth a lot less. By the end of that period, they'll buy you less energy, less house, less stocks, less gold, however you want to phrase it. And so that's, I think, what we find ourselves in now that's very similar to that period in the 40s. And it really applies for pretty much the entire developed world. It's not just the United States, it's also Europe, it's Japan, it's a number of other countries where we all kind of collectively have so much debt in the system that there's no way to, both public and private debts, just kind of this long period of credit growth that, now they can't really get rates below zero anymore. And now there's inflation, and now we have kind of real world supply constraints, large fiscal expenditures, big increase in the money supply. And so you get this period where, the Fed is raising rates, but they're raising them, even though they're raising them kind of quickly now, they're raising them from such a below point compared to inflation. And they're already getting signals of like yield curve inversion and then, kind of signs to the market that they might not go as far as they claim they will during a period of 9% inflation. And I think that's what we get when there's this much debt in the system. So generally when a central bank runs into a problem where debt is that high, especially government debt, but really the whole, the public and private sector combined, super high debt levels. You know, in the aftermath of a private debt bubble, it's usually not an inflationary problem because you just got a reduction in demand. So you have overcapacity for a lot of things. But after you spend like a decade working through that and not really investing in commodities and not investing in new facilities, eventually you kind of find yourself more supply constrained. And so when you have high debt levels and then you run into like a commodity bull market, right? So you've underinvested in energy, you've underinvested in transportation refining capacity, underinvested in certain mines, many of which take years to bring online. And you start to get that inflation from that, but you also have super high debt levels. That ends up being kind of checkmate for a central bank where they have high inflation, but they still can't raise rates to positive real levels. And so historically, one of the options that they can turn to is yield curve control, where they say, look, we're going to hold short-term rates, at like zero, and we're even going to keep buying government bonds with printed money to suppress their rates as well, basically an unlimited bid for, government bonds above a certain yield, meaning below a certain price, to maintain that. And so, for example, the United States did that in the 1940s, and right now we have Japan doing that. So, you know, short end rates are super low, and then even their long duration rates, they're pegging them at 0.25% for the 10-year, while their official inflation target is 2%. They pretty much have a implicit stated goal for negative real rates kind of across their duration spectrum. And that's kind of a reality when you have 250% debt to GDP and then plus all the private debt in the market. We also see Europe encountering similar problems where you have Italy with 150% debt to GDP, can't print their own currency, and so they're relying on the ECB to maintain their bond yields, at reasonable levels, so you don't get sort of a fiscal spiral. So the question is, what happens when you get high inflation, but still people don't want Italian bonds, and you end up having QE into an inflationary spike, basically suppress yields, below the inflation rate, and make them comparable to owning U.S. Treasuries. Whereas if you ask, you know, 99 out of 100 investors would say they'd rather own US debt than Italian debt given similar yields, maybe even 100 out of 100. And yet, you kind of have to just manipulate things. And so generally what you get in that environment is financial oppression, meaning that if you're a saver or you're a bondholder, you kind of get screwed over. And if you're a real asset owner, and if you have, say, debts that are, manageable, like a long-term mortgage or something like that, you're generally a beneficiary. And so there are multiple winners and losers in that type of environment, but it's at least something to be aware of because almost nobody with a printing press will ever fail due to lack of money, right? So it's kind of like follow the money, follow the incentives for how it's going to go. And yeah, historically, when you get super high debt levels, it's like, those become unpayable. And then the question just becomes, are they going to be unpaid in nominal terms? Like like what happens in emerging markets sometimes, or are they going to just be not fully payable in real terms? And in developed markets, that's generally what you get. That's kind of checkmate for central bank policy until such time as you've inflated enough debt away, or you've had some sort of reset that allows like another cycle to begin from there.